What we're seeing right now with silver is not a normal market move. And it's important to say that clearly, because too many people are still trying to explain this moment using old rules that no longer apply. A move toward $110 in a matter of 48 hours is not speculation getting a little out of hand, and it's not retail traders suddenly discovering silver all at once. This is pressure that has been building quietly for years, finally finding a release point. For decades, silver's price has been shaped less by physical reality and more by paper promises, by contracts stacked on top of contracts, by leverage so extreme that a single ounce of real metal has been represented dozens, sometimes hundreds of times over in the financial system. That structure only works as long as people don't ask for delivery. And what's happening now is that people are asking the moment physical demand overwhelms paper supply, the illusion breaks. Futures markets can quote whatever number they want on a screen, but they cannot print metal. Vaults cannot deliver what they do not have. And when buyers, especially large buyers, stop caring about paper prices and start paying premiums for immediate delivery, the real price reveals itself very quickly. That's why this move feels violent. It's not silver going crazy. It's the market snapping back to reality after being held underwater for far too long. Now look at where this pressure is coming from. The Shanghai premium exploding is not a side story, it's the story. When silver trades at a significant premium in Shanghai compared to Western exchanges, it's a signal that the global pricing mechanism is breaking apart. It tells us that in parts of the world where physical settlement matters more than financial engineering, silver is already being valued far above the paper price. That gap doesn't stay open for long. Either metal flows east until inventories are drained elsewhere, or the price resets upward to slow demand. There is no third option, and this is where the system runs into trouble. Western markets have grown comfortable pricing silver as if it were infinitely available, as if supply could always appear when needed. But silver is not just an investment asset, it's an industrial necessity. It's used in energy systems, electronics, medical applications, and emerging technologies that cannot function without it. At the same time, mine supply has been constrained. Grades have been declining, and years of underinvestment have left the pipeline thin. When investment demand collides with industrial demand in a market that has been artificially suppressed, the repricing is not gradual, it's explosive. The speed of this move matters just as much as the level. 48 hours is not enough time for institutions to hedge properly, not enough time for banks to quietly source metal, not enough time for narratives to be adjusted and sold to the public. That's why this moment is so dangerous for those who have built their strategies on the assumption that silver would always remain manageable, controllable, and cheap. Leverage amplifies everything on the way up just as it does on the way down. Positions that look safe at $25 or $30 suddenly become existential threats. Margin calls cascade and liquidity evaporates. What's really being exposed here is confidence. The paper silver market is not backed by metal, it's backed by trust. Trust that contracts can be rolled instead of settled. Trust that cash settlement will be accepted instead of delivery. Trust that the system will always function as it has in the past. But confidence is fragile. And once it cracks, it doesn't fade slowly, it disappears all at once. When participants begin to doubt whether paper claims are interchangeable with physical ounces, they rush for the exit at the same time. That's when price stops behaving politely. This is also why calling this a silver rally misses the point. Rallies are driven by optimism. What we're seeing is driven by necessity and fear of not being able to source metal, fear of being trapped on the wrong side of a structural shift, fear that the old price was never real to begin with. Silver is not just rising, it is being reevaluated. And when an asset that has been suppressed for decades is suddenly repriced in an environment of tight supply and global demand, the numbers that once sounded impossible start to look inevitable. For the broader financial system, this moment is deeply uncomfortable because silver sits at the intersection of money, industry, and trust. It exposes how detached financial markets have become for a physical reality. It raises questions about other assets, priced primarily through derivatives rather than delivery. And it forces a conversation that many would prefer to avoid. What happens when too many claims chase too little substance? Silver is simply the first stress point, not the last. So when you hear disbelief, mockery, or dismissal, understand where it's coming from. It's easier to laugh at the idea of triple-digit silver than to admit that the system pricing it may be fundamentally flawed. It's easier to blame speculators than to confront decades of distortion. But markets don't care about comfort, they care about balance. And when balance is lost for long enough, the correction is swift and unforgiving. This is not about hype, and it's not about predicting a number. For the sake of shock value, it's about recognizing a structural break when it happens and understanding that once the physical market takes control, the paper market must follow. The clock doesn't reset and the pressure doesn't disappear. It only finds a new price that reflects reality, whether the system is ready for it or not, What makes this moment truly dangerous for bullion banks is that it isn't just a bad trade or a temporary imbalance, it's a full exposure of how fragile the system really is when confidence collides with physical limits. For years, banks have operated under the assumption that silver could always be sourced if needed, that delivery obligation could be managed through paper shuffling, rolling contracts, or settling in cash when things got tight. That assumption is now being tested in real time, and the results are not looking survivable for everyone involved. When the market demands metal instead of explanations, leverage stops being a tool and starts becoming a weapon turned inward. The core of the problem is simple but uncomfortable. There are far more claims on silver than there is silver itself. This has been an open secret in the precious metals world for a long time, dismissed as irrelevant because it never mattered until it mattered all at once. Rehypothecation, layered derivatives, and synthetic supply all function smoothly when participation is passive and trust is high. But when large players decide they want physical settlement, the math stops working. You can't hedge your way out of a shortage. You can't paper over a missing ounce. And you certainly can't print silver to meet delivery schedules, as Asian markets, particularly Shanghai, continue to pull physical silver at rising premiums. The strain shifts from theoretical to immediate. This isn't about arbitrage traders chasing spreads. It's about metal leaving the system and not coming back. Each ounce that moves east tightens the noose around Western inventories, reducing flexibility and increasing stress. Banks that once relied on the idea that someone else would settle later are now facing the possibility that there may be no one left willing to play along. When that realization sets in, panic doesn't announce itself politely, it shows up as forced buying. Emergency measures and sudden changes in rules, this is where the word massacre stops sounding dramatic and starts sounding descriptive. Banks on the short side of silver are not just exposed to rising prices, they are exposed to delivery failure, reputational damage, and systemic risk. A rising price hurts profits. A failure to deliver destroys credibility. And credibility is the real currency of financial institutions. Once counterparties begin to question whether obligations can be met, the entire structure starts to wobble. Margin calls multiply. Liquidity dries up. What was once a controlled environment turns into a scramble for survival. The deeper issue is that this system was never designed to handle a coordinated demand for reality. It was designed to manage perception. Price discovery was supposed to happen in futures markets, guided by volume and leverage rather than physical flow. That works beautifully when physical markets are quiet and compliant. It fails spectacularly when they assert themselves. Shanghai is not negotiating with narratives or forecasts. It is responding to demand and availability. When premiums explode there, it's because buyers are willing to pay more to secure metal now, not later, not in cash, not in promises. This shift represents a transfer power that goes far beyond silver itself. It marks a movement away from price setting by financial centers toward price setting by physical markets. That's a profound change, and it doesn't happen smoothly. Institutions that benefited from the old model will resist it down PL, and attempt to contain it. But containment requires supply, and supply is exactly what's missing. When control is based on abundance, and abundance disappears, control disappears with it. For investors and observers, this moment offers clarity if they're willing to see it. It reveals how quickly stability can unravel when it's built on leverage instead of substance. It shows how interconnected global markets really are, and how a stress point in one region can cascade across continents. And it reminds us that trust, once broken, is nearly impossible to rebuild at the same scale. The silver market is small compared to equities or bonds, but that's precisely why it matters. It moves faster, breaks sooner, and signals problems before they become impossible to ignore. What's unfolding is not just a repricing of an asset, it's a repricing of risk. The risk that paper claims may not equal real value. The risk that systems optimized for efficiency collapse under stress. The risk that confidence can vanish overnight. Silver is simply the messenger, delivering news the system doesn't want to hear. And history shows that when messengers are ignored, the consequences only grow more severe. So as the pressure builds and the old safeguards fail, one truth becomes unavoidable. Markets can be managed, influenced, and delayed, but they cannot be denied forever. When reality asserts itself, it does so without mercy, without negotiation, and without regard for who is unprepared.